Welcome to Adding Value with Shy Assar, the show where we dive into the stories, strategies, and market insights shaping the world of industrial and logistics real estate. In each episode, we sit down with industry leaders, investors, developers, and tenants to explore their journeys, unpack current market trends, and share takeaways that can help you better understand and navigate the business. You guys can work through this, right? Like you can
screw up all you want. You can screw up all you want. You're doing real well on this to start. So I see things being positive going in.
Well, it means good news for all of us.
I hope so.
Yeah.
If not, you can roll back the tape and yell.
Yeah, that's right.
I would say a common trait and something for young people or new people in the industry to think about for successful brokers is the ability to listen.
Value creation is not just about the numbers and the financial stuff. It's about creating value for our customer.
I remind myself, like, this is the business we got into. This is what we got into.
Yeah.
The prerequisite was that you just don't give up.
We having the Kelsey brothers on next time?
Maybe, who knows? In the Inland Empire West, the engine stalled. We saw net absorption turn negative by 445,000 square feet. In the Inland Empire East, while there is activity, the market is flooded with options. Vacancy has officially climbed past 10%. By all metrics, the market has taken a hit. The headlines will tell you that the West is softening and the East is oversupplied. But headlines don't tell the whole story, because right in the middle of that softening, in the West market on November 7th, our team sold the most significant transaction of 2025. 10681 Production Avenue in Fontana, a 1.1 million square foot distribution facility we sold for $174 million. While the spreadsheets say the West is pulling back, a buyer just placed a $200 million bet on its future. That is a massive signal that the smart money is seeing something the averages are missing. To reconcile these two realities, the data that shows a hit and the deal that proves a strength, I'm joined by my teammates Sean Sullivan and Juan Gutierrez from our Ontario office. We are here to separate the noise from the numbers. Welcome to the show. Juan, thank you for coming today. Let's just dive right into it. In the last quarter of 2025, we sold together a 1.1 million square foot warehouse in Fontana. And even though the market was kind of in a soft place, an investor made a huge bet on a value add strategy of buying this building on a lease-up assignment. Can you tell us a little bit about how this deal came together and why it may or may not be an outlier of what's going on in the market?
Yeah, it's actually an interesting story. We don't need to dive into all the details because we don't have enough time, but this particular owner owns 4 buildings in Southern California. And I think around the summer, I think it was probably June or July, we got wind that it was time. The seller had decided that it was now time that they were going to sell these assets. And so what they started to do was collect offers, and it was kind of an off-market situation, quasi off-market. But they collected, I would say, a handful of offers on different buildings. And in this particular one, the one in Fontana, I think was more so the asset that they decided was the one that was going to get the most value for the seller. And so they decided to transact on this one first.
Sure.
And what ended up happening is the seller accepted an offer. We went under contract. This must have been, I think, probably August or so. And the deal closed in November. It ended up being, I think, the largest square footage size sale of the year. And I think the second largest sale of the year in terms of dollar value. There was another sale in Riverside. Sure. That was actually larger in dollar amount.
It was interesting because I remember when we were kind of we had been advised that we had to solicit a couple offers, right? Because they wanted to see, even though it was technically sold off market, they wanted to see some form of process to determine where the market was going to shake out to for the asset. And in that time, and maybe even to a degree today, many of the institutions were hands off on vacant buildings. But the Fontana asset, given that it was 1.1 million square feet, that's really the one that garnered the most interest. What do you think, or can you kind of advise on why that asset was considered the most appealing in the portfolio?
I would say it was 2 reasons. One, obviously, it was just bigger. I think if you look at the vacancy rates of all of the different size ranges in our market, the best size segments are actually the smallest buildings below 50,000 square feet, and then the really large buildings over 700,000 or 800,000 square feet. And so I just think from a vacancy rate and a supply demand ratio, the larger buildings provide something that an owner feels more comfortable buying in a market,
Sure.
this type of market.
It feels like there is more confidence in making a bet in this market because, I mean, we, for example, did a competitive set. And when you look at the 1 million square foot space in the Inland Empire West, there's only 2 or 3 other buildings, right?
Yeah, that's right.
2 or 3 other buildings. And when you take into consideration how challenging development is in California, couple that with the fact about how much land you would need to build a 1 million square foot warehouse.
Yeah, it's about 50 acres.
Yeah.
Yeah.
It's pretty much irreplaceable.
Yep.
It's irreplaceable real estate in a environment where you're really, if you're in a kind of soft leasing market, and if you're going to make a bet, you might as well do it with a trophy asset with few competitors. And that's why I think, for that, it might be, I think that's one of the reasons why there was interest to buy that Fontana asset.
Yeah, I mean, you'd be surprised. I mean, you helped me in the process. I mean, it was surprising that a lot of the logical buyers that we thought were going to make offers kind of were on the sidelines at the time.
Yep.
A lot of people didn't even want to make an offer right now. I just think that there's a lot of investors that are on the sidelines, due to the fact that vacancy rates are still going up in the overall market. I mean, we started the year off, I think, at roughly 7% overall, and we ended the year at roughly a little bit almost 9% overall. So this is both in the East and the West. We're seeing vacancy rates still increase, and a lot of investors are on the sidelines due to that.
Sure. And I think a key piece of this, and there's some sensitivity and confidentiality about the deal, so we can't speak to exact specifics, but roughly, the buyer is buying the building for less than $200 a square foot, somewhere between $150 to $200, right? And when you look at what replacement cost looks like, they're buying it way below replacement cost. So it feels like even in an environment where there might be some hesitation, if you were going to make a bet, this deal checks a lot of boxes. And I think the way they were looking at it, just based on kind of the underwriting metrics, I mean, where would you say it's technically going to be vacant, right? It's going to be delivered vacant. It's going to be available for lease. There's going to be a lease-up strategy behind it. What do we underwrite for lease rents on that building?
I think market rents for buildings like this right now are going to be roughly $1.40-ish gross.
Right.
And I just think you need to back out your operating expenses for something like that. But these bigger buildings are actually leasing for more than the mid-size buildings. In 100 to 500,000 square feet is leasing for less than the larger buildings. So. But to answer your question, it's going to be somewhere in that $1.40 gross range.
And in many ways, the building checked a lot of boxes as far as functionally as well.
Yeah.
I mean, it was a second generation building. It was the early 2000s it was built. 32-foot clear, cross dock, plenty of trailer spots, plenty of dock high doors, great location. So at $1.40 gross, we're looking at closely $1.10 net, plus or minus stabilizing, right, being market rents. And my understanding was that it was, taking in all the considerations for assumptions as far as downtime, carry cost, tenant improvements, capital expenses, maintenance expenses, stabilizing at roughly at 6 3/4. So again, that gets your basis up to what I have here, about somewhere in the $200 a square foot range, $205 a foot range. Which allows them to, once it's stabilized at 6 3/4, to potentially sell it in a couple years at say a 5.5 cap, and it's a pretty decent spread. I mean, it's going to be a huge win for the buyer.
Yeah, and I think that's interesting that you use the math to back into this all-in number of roughly $200 a square foot. And I'm just, as you were talking about that, I'm thinking to myself in my head. I mean, back in 2022, when we were still going up in values, some of the buildings in our market were selling for $400, almost as high. There was one building that actually sold for more than $500 a square foot. So that shows you, on a comparative basis, we've gone from $500 a square foot down to roughly $200 a square foot in 3.5 years.
Sure.
The feedback that you got from the buyers, some of the institutional buyers that didn't offer, was it based on just underlying vacancy rates?
Well, I think a lot of groups had a couple of two things going. Some of them already had vacancy, so it's a tough pitch to sell to say, "Hey, let's
add another million square feet."
Yeah, let's make a $200 million bet and let's add to the portfolio.
Yeah.
And also, I think it's also a function of capital. This specific buyer felt like they had fresh capital and did not necessarily have that vacancy exposure, and was pretty bullish and contrarian that right now is a good time to make a bet.
Yeah.
And I think when you look at this deal, right, you look at the price per square foot, you look at the location, you look at the competition. There is, I don't want to say minimum downside risk, but it feels like if you were to buy a building somewhere between 150 to 200 bucks a foot in the West with this profile, like how much money could you possibly lose? You know what I mean?
It feels like a home run. I mean, that's why I asked, like, what was the, what was the
I think it's just,
feedback
I can't really speak to kind of all the investors, but that's the sense at least that I got. Would you agree?
Yeah, I think so. I think making a big bet is preferably to do it in the West as opposed to the East. And I think the building is in a size range where a lot of big investors feel comfortable with.
Let's pivot to the market report and let's focus on the West, less than 100,000 square feet. Vacancy rates shook out in the Q4 to roughly about 5.28%. And the truth is this segment has weathered the storm better than every other segment. And if you're a tenant in the market today or a buyer in the market today, it feels like relative to others, it's the most competitive set that is out there. So Sean, we've done a lot of business together, especially in this segment.
Yeah.
Why do you think that the 0 to 100,000 square foot space has weathered the storm the best?
I think that there's just, as you said, there's just less product. And I think that these companies that are in that segment, there's a lot more of them, first and foremost. So there's less product and there's more tenants for this space. So they're certainly not building more of it. It's too expensive to build. And so the buildings that are getting built are, really above 100,000 square feet. And so as you have these companies that, I think that tenant base continues to grow as well. So you have less product and more tenants, and I just think that's the...
Well, the thing is, you bring up a good point. The thing is that I've been in the business since 2014. You and I actually started right around the same time.
Yep.
I know, Juan, you've been in the business for probably twice as long, but I can only wind back the clock.
We're all the same age. I just started earlier than you guys.
No, Juan's actually 50. He's actually a vampire. So I can, you wonder if you guys agree. I can't really remember, outside of maybe a handful of development projects, there really, in the last 11 years, haven't been any small building projects. There's been a couple here and there, but that inventory has stayed stagnant for the most part for at least 11 years.
Well, it's just expensive to build, man. You have to, and certainly right now, it doesn't underwrite. It doesn't pencil. And so, to Juan's point, where the valuations were peaking sort of a few years ago, that's where it really started to make some sense. But now, certainly now and prior to a few years ago, the smaller developments just didn't make sense for these guys to build.
I think it's also kind of a situation where a lot of that product is owned by the mom and pop owner users, right? So you start taking out a certain segment of that inventory is owned by local owner users. Now you have a certain segment that's available for lease.
Yeah.
That segment that's available for lease is not very institutional, right? It's not like, and so they're owned by mom and pop private owners,
absolutely,
who have flexibility in dropping lease rate. And the lack of inventory and the demand that's continued to exist, that market has, for the most part, weathered the storm. I mean, it's kind of like a double-edged sword. It would be great to own a 10 or 20,000 square foot building somewhere in the West, if it's a nice building, because that there's always going to be some form of demand or a tenant that's going to be coming in and out of it. The flip side to that is, because the prices have held, as an investor, if you wanted to buy one today, well, you're pretty much going to have to pay user pricing, which means on a return basis, it's going to be tight.
Certainly. Yeah.
We worked on, Juan, you and I just recently completed, let's talk about a deal we just did. We recently represented a tenant, a company called NeilMed. They occupy a 90,000 square foot warehouse, Class A warehouse in Ontario, 981 South Wanamaker. This is a good kind of, I think, case study for where combination of two things: rents holding strong, but at the same time, if you're a tenant with good credit, that you can get good concessions, even in a renewal. NeilMed is a company that they do nasal sprays. They're a global company. We put them in there about 5 years ago. That lease just got signed for $1.11 triple net. And I think the operating expense, if I'm not mistaken, are roughly 30 cents. So you're grossing out $1.40. $1.40. Having said that, they got 5 months of free rent on a 5-year deal, and about a 50 cents a square foot in tenant improvements. What's your opinion on kind of where that deal shook out at?
I think it was a good deal for everybody. It's, it's a renewal, so the tenant didn't have to pick up and relocate elsewhere. But as you mentioned, that building is very well located in Ontario. I mean, you can see it from the freeway. It was kind of a pride of ownership on the location. So I think that you can maybe make the argument that market is a little bit less than that, but not by a lot. And I think that it was an overall a win-win for the landlord and the tenant.
For sure. A quick note for our listeners. If you're an owner, asset manager, or leasing manager with a 100,000 plus square foot building in vacancy coming up in the next 18 months, I'd love to talk. A lot of assets in this market have been represented by the same legacy brokers for years. Sometimes that works, and sometimes it doesn't. If you're ready for a fresh, aggressive approach to reposition and market your property, please contact us. I'm Shy Assar with Voight Real Estate Services, and let's add value to your portfolio. So Sean, you and I just recently closed a deal in the fourth quarter of 25. We represented a user who purchased a 62,000 square foot warehouse in Jurupa Valley, brand new construction building. I think this deal serves as a great case study as to what it's like to be a user in this market, and on both sides and on the broker side. So can you tell us a little bit about the history of this deal?
Yeah, I think this deal is a great, like you said, I think it's a great picture of what's happening in the market currently. I think what happened here was motivation on both sides. And it happened at the same time. Coincidentally, we had looked at this building very early in our process. This deal took us probably about a year and a half to complete.
We were working with them when we first got the assignment on the purchase requirement. We had worked with them for over a year, showing them different sites. So can you kind of take us a layer back and kind of share like that process? Because in many ways, it was very much an educational process for the buyer. Oh,
certainly. We met with them a year and a half before they closed escrow, and they knew that this need was coming. They had the motivation, but the urgency wasn't there.
Sure.
And when we met with them, they knew that this need was coming. And so we do what you do. You show them all the buildings on the market. You show them a couple that off market. And as we're sitting there, we kind of zeroed in on this Troy Court building.
Sure.
That we ultimately ended up transacting on. But at the time, the motivation for the seller was not there.
Right.
And I think what ended up happening is because the pricing was so much higher when we started the process, we ended up exercising the whole market.
But we looked at land.
We looked at land.
We looked at land in Menifee.
Yeah.
Well, I think a piece of that was also to, they wanted to, given they were a user, they definitely had sophistication.
Yes.
They were a successful company. Having said that, this was an area where they were getting educated as the process went on.
Yeah, and the reason they were comfortable even looking at land is because they'd built their existing building that they occupy in Chino. So that they were comfortable looking at land all the way out in Menifee. I think all it took was one drive out to Menifee for them to realize I don't want to be in Menifee.
Yeah.
Because we quickly closed that. We closed that chapter, and they said, we've now have refocused our efforts in the West. So ultimately, that led us back to picking off different deals here and there, and the pricing just didn't shake out in that first sort of phase of the exploration, and so we kind of just had to wait, honestly, for the timing for our buyer to become more motivated and the need to really push on that urgency button. And then by the time that ended up coming into the picture, the seller had become more realistic on pricing, and we really revisited the Troy Court deal, and ultimately they had a new listing broker come in, and that just, I think it brought everybody back to the table. And when that happened, things moved pretty quickly, and we got into escrow.
Yeah. I think what was interesting about that whole process was, through exercising the whole market.
Yeah.
East, west, buildings, land. I think it became very clear. A couple things became very clear. It doesn't make sense to buy land and build, right? If you're a user,
Yeah.
right? If we're like, and especially if you're in a sub 100,000 square foot space.
Yeah.
First of all, the land doesn't exist.
Yeah.
Second of all, it's going to cost you so much money. Then it just doesn't make sense. You might as well buy existing product.
Yes.
That became clear, and really the site to your point about pricing starting to align, that and timing starting to align. It became clear that if you were a user today and you're looking to buy a building, a good building that fits your needs in the business, and you're paying plus or minus $270 a square foot for a brand new building, that's actually a good deal, right?
That's a great deal.
Like, any way you slice that up, that's a good deal. Now the challenge becomes, financing, though historically, relative to historic standards, is not that expensive, your financing costs ends up being a lot higher rather than if you were just to rent it, lease it, right? It's a lot cheaper for you to lease the space.
Right now, yeah, certainly.
So a lot of folks just are not using debt to necessarily buy these assets. But if you're in a liquid position, like this group happened to be, and they're a strong family business, then you can exercise your right to take advantage of a time in the market and buying what we consider a good deal.
Yeah, and these guys have been in, I don't know too much about this particular user, but a lot of users that are looking to buy right now that have been in business for 15 or 20 years, they've seen the prices go from $50 a square foot all the way up to $500 a square foot, now back down at, 250, 300 a foot. And I think they see value there, and especially if they're going to be running a business and operating for the next 15 or 20 years, this is probably a good time for the users to step in and start buying buildings.
Sure.
Yeah, and that was one of the conversations we had. Back to your point, about building the building is ultimately that if you ran the numbers, this building ended up being below replacement cost.
Yeah.
And so when you outline it that way, because that's one of the valuation metrics we use is replacement cost. And when
somebody else did it for you.
Yeah, exactly.
I mean, you don't. Yeah. So
exactly.
Somebody else did it for you, and you're buying it for less than it would cost if you went out and did it yourself.
Exactly.
Yeah.
Let's pivot to the soft segment in the market. The 100 to 500 in the West, 1 to 250 and 250 to 500. The 1 to 250 took a little bit of a beating in the fourth quarter.
Yes.
We had negative absorption of about 700,000 square feet, and vacancy rates are roughly at about 8.25. And so why don't we just take it from the top? What do you guys think is happening in that segment between 1 to 250?
Go ahead.
Well, Juan and I have a building in Rialto listed with Aries.
Sure.
It's a great building. It's a 200,000 square foot building, brand new, 36 foot clear, 180 foot truck court. Just a great building. All the bells and whistles you could imagine. And that building specifically happens to sit in Rialto, which if it's a hot market, Rialto is sort of looped in with the West.
Sure.
And if it's a down market, which we happen to be in a little bit of a down market right now, it's looped in with the East. And so you kind of have to, it's an interesting needle to thread when you have a building that sits in Rialto of trying to figure out where the pricing sits and what the motivations of the landlord ultimately are. And so I think to speak to that size range specifically, I think that was an easy size for developers to pick up in the last run up.
Yep.
That 5 to 10 acre size. And so I think a lot of those buildings in that size range got built in the last run up, and year over year, we were somewhere between 20 to 25 million square feet under construction, running up into COVID and probably through,
there's a lot of inventory built.
The
in
end
that
of
size range,
2022.
from 1 to
Yeah.
250.
Yeah. So
Because you're 100% right. Because 5 years ago, if you had a 5 acre, 7 acre site to sell in the West, it was like gold, right?
It's the best.
And really they were we had 100 250s popping up left and right. And the tenants that were moving into those spaces, because when you kind of look at least in our market, the tenant that moves into a 150 is really growing out of, let's say, a 50, or 100 goes to a 250 is growing out of 100. And though there are good credit profile tenants in that sub 100,000 square foot range, a lot of them are for the most part newer ventures, especially with the proliferation of e-commerce and fulfillment and a lot of Asian related companies. So all this space got filled. And now a few years later, we have a glut of inventory in that space, and a lot of tenants are just not renewing or whatever the economy is impacting them.
Yeah, I was just going to say, I mean, we're starting to see, I mean, we're five or 6 years post-COVID now, and we're actually starting to see some tenants that signed 5-year leases during COVID, that their lease is now coming up for expiration, and they're just giving the space back because it's excess real estate for them. They took on too much space during COVID, and now that their lease is up, they just don't need it anymore.
Yeah, we actually, you have a one you and I have. We have a 200 in Fontana that we recently have on the market, and that was kind of the profile of an American company, if I'm not mistaken. But when we had kind of toured the space, what was one of the things that they mentioned about the lack of activity in their warehouse and why they're not going to be renewing?
Yeah, we were just touring the space with the tenant, and we were kind of just talking to them about their business and, you know, the reason why they were not going to stay there. And the lady,
3PL, right?
yeah, the lady that was running the warehouse, she said that at the beginning of the year they were bringing in 25 containers a week, and then post Liberation Day tariffs, it basically went from 25 containers a week down to 3 containers a week.
So the impact is real.
Yeah, it's real. I mean, you could see, we walked through the warehouse and it was probably 20%, 30% full.
So just in a little bit of a preparation for today, I ran through our comp set, and these are for new deals that were signed, right? And deals that were signed after October 1st.
Yeah.
So this is not including deals that might have been signed in September and they took occupancy in November.
Yeah.
We're just talking about October 1st, officially new deals that were signed in the last quarter of the year. There's 4 leases signed between 1 to 250, and you know the average rate. Now, having said that, and we can provide the comp set if you guys want to reach out, but they were in Class B buildings, so second-generation buildings in the West, and the average rate, and we're going to talk on gross numbers because everything's being established on gross, was $1.20 a square foot gross.
Yeah.
Which feels light, but feels at the same time feels right. And the profile of those companies, not surprising, was 4 Chinese companies that signed those leases.
Yeah.
Yeah, it doesn't surprise me at all. They've been the most active on the tenant side for the last 24 months. Chinese 3PLs and e-commerce companies.
When we look at the 250 to 500 segment in the West, you know, absorptions relatively remain flat, and vacancy levels are about 7.43%. I think probably one of the reasons that might be the case, and correct me if I'm wrong, is maybe the 250 to 500 segment, there's not as much inventory, right, as the 1 to 250, which is kind of stayed up with the demand. But in general, we were talking about how the tariffs has impacted leasing velocity. Can you kind of shine some light on what you've seen in 2025 on your end on the listings that you've had? Yeah,
sure. I would just say, if you start at the beginning of the year, I think most of the brokers that you talk to would have told you that the year started off. It was feeling good. There was a lot of leasing activity in the first quarter.
There's a lot of absorption.
I mean, if you look at the market statistics for the first quarter, I think vacancy rates actually went down. And then we had so-called Liberation Day and the tariffs. I think that was roughly April or so. And so the second quarter, the third quarter, and the fourth quarter of the year, I mean, we just saw vacancy rates continue to go up. It sort of felt like there was very little activity the second and the third quarter. I will say that the fourth quarter sort of feels like there's more life to it. But you can see the trend line in the vacancy rates. They went down in the first quarter, and then they started to go up and continue to go up through the remainder of the year.
Sure.
Yeah, I think the previous 8 quarters to Q4 of 2024, vacancy was rising, and then in Q4 of 2024, it was the first quarter it dropped. And so I think, to Juan's point, there was a lot of positive momentum heading into this year, and then once the tariffs hit, it just kind of fell flat.
Mm-hmm. Moving to the 500,000 square foot space, which is actually really interesting because 500 and up, bigger buildings, net absorption has been relatively stable, but at the same time, the lease rates are substantially higher than the rest of the market in the 500,000 square foot space and up. Why do you think that dichotomy exists?
My opinion on that is that it's mostly due to the fact that there's less inventory. I mean, to build 500,000 square feet, you need roughly 25 acres. And in the western part of the market, that's almost non-existent. You can still find 5 or 10 acre parcels, but that'll only get you 100 or 200,000 square feet. So I think that it's that's the main reason. It's very hard to find sites to build these larger buildings, and so therefore, they tend to, once they're occupied, the tenant tends to stay in there and they really don't get out of the building.
And you bring up a good point because, I mean, this kind of ties back to the sale that we did last year. I mean, and it's a combination of a couple things. One, far less inventory. Profile of the tenant that's going to go into 1 million square foot or 800,000 square foot is very different than the profile of a tenant that goes into 200, right? I mean, credit-wise. Fewer options. There's one renewal that we can speak to that kind of highlights how rents are higher in the higher size ranges. There was a renewal at 10825 Production Avenue, which is the 700,000 square foot and change building just next door to the asset that we sold. And that building leased for about $1.05 triple net on a renewal with a 30-cent OpEx, grossing out right there at that $1.35 a square foot. What felt like on a long-term deal with about 12 months of free rent. So that's kind of like shows that when you're comparing deals that we were speaking to at $1.20 a square foot gross and the 1 to 250, and then we have bigger deals that are leasing at higher numbers, it kind of speaks to kind of that dichotomy that exists.
Yeah. And that's an interesting point, though. It did have 12 months of free rent, so you got to take all that into consideration. And it was a renewal, but I mean, that's a pretty interesting example of where I think the landlord just didn't want to have any vacancy. Because I think that's the other situation is that the landlords also take into consideration if they push too much on a renewal, do they really want to get a vacant building back right now? And I think the answer is no, because you're still going to have 6 to 9 months to find yourself a new tenant, and then you're still going to have to offer that new tenant 6 months, 9 months of free rent for a new 5-year deal.
Sure. And you have market risk.
Yeah.
Right? At least now in that case, it was a credit tenant. It was a 100-month deal. But at least you know who you have, credit tenant. You might as well give them a good deal to stay versus the alternative, which is to, find out what may happen 6, 12 months from now. Guys, moving into the east, the 1 to 250 range, that space is, vacancy actually dropped slightly to about 13%, despite with some healthy leasing velocity. But I think there was about 8 new leases signed during that time. You guys currently have a listing right now, 1 to 250 in the east. Technically Rialto would be considered the east. Are there other ones that you have?
Rialto is considered the east. Yeah, I have a 198,000 square foot building there.
Yeah. What do you think is going on right now in the Inland Empire East between the 1 to 250 range?
Rialto is kind of a tweener market. So when the market's hot, you get West End rates, but when the market is not so great, you're sort of being dragged down with the eastern part of the market. I think right now, when a tenant in this particular size range goes out and looks for a new facility, and you pull up the inventory of the availabilities, they have somewhere between 15 and 20 different buildings that they can look at. So there's really, I mean, would your number say 13% vacancy in the size range? I mean, we have a lot of inventory right now. Tenants have a lot of options, and landlords are having to get more aggressive with their concessions.
So those 8 deals signed, and we ran kind of, again, back on the gross numbers. And keep in mind, all these deals obviously come with a level of concessions, whether that be a little bit of TIs, but typically there's 1 month of free rent with every year of the term. Mm-hmm. The average shook out to about $1.12 a square foot gross on class, and most of that subset of new deals that were signed, and we're not talking about renewals, but we're talking about mostly new space that was taken, were Class A buildings. Now, what's interesting about that is technically Corona is considered the IE East, at least in most market reports. Yeah. And that's kind of a skewed number, $1.12 quotes, because Corona's averaging lease rate is roughly closer to the West numbers, which are Class A building being closer to about $1.30 or $1.35 gross. There was a deal that was done in Perris, I believe, which was with the Carson companies. And I think that's a little bit more reflective of where the Inland Empire East is at. Do you remember where that deal shook out at?
I think the start rate was like 95 gross.
Yeah, it was like 75 plus 20.
71 plus 23, or 71 and a half plus 23.
Is that in Perris?
Yeah, it's in Perris. It's a second generation building that was built during COVID. It leased. So, I mean, the landlord in that situation they're not delivering a brand new building, but they delivered this 5 years ago. So their basis is lower. And I think that was one of their competitive advantages is they're able to undercut the market because it's not a brand new deal.
And it's a tenant with credit. Yeah. Right. I mean, and that kind of just, I think it's indicative of, right now there is a lot of inventory and most tenants that are out there now, given, the profile of tenants that go to the East are usually different than the profile of tenants on the West. But a lot of tenants out there have pretty spotty credit. And so if a tenant were to show up and they have solid financials, I think you're able to find pretty motivated landlords that can give some good deals.
Yeah. I mean, to your point earlier about the concessions, on that specific deal, they got 6 months free plus 6 months early occupancy.
Wow.
So they got basically a full year in the building free.
Yeah. Moving to the 250 to 500 range, that segment is roughly about 19% vacant. This is in the Inland Empire East.
This has to be the most beat up
segment in the market.
in the entire market.
And which means at 19% vacancy, 1 out of 5 buildings are sitting vacant, which is kind of a scary sight. What do you think is kind of happening in that segment of the market, and why is there so much challenge in moving product between 250 to 500 in the East?
I think this goes back to our earlier comment that when the market was hot in 21 or 22, I think developers they were trying to buy whatever they could to deliver new inventory into the size range. And at that time in the East, they were buying 20-acre parcels, 30-acre parcels, rough plus or minus. And so now they started delivering all this inventory, and they delivered it into a market that was sliding in the opposite direction. So some of these buildings in the eastern part of the market have been sitting vacant for close to a year, in some cases 2 years. And I just think that they're all competing with each other, and this size range was overbuilt.
Well, and let me ask this question because maybe it was before my time. Was the East just historically a 500,000 square foot plus market, and it kind of developed into a market with inventory with 250s to 500 in the last cycle?
Well, that depends how far back you want to go. I mean, when I started in 2006, the East was a market where, Redlands and San Bernardino and Perris and Moreno Valley, there really was very little out there. It's just mostly built-to-suits, but it was a market where developers were going out there because they could buy 30, 40, 50-acre parcels and build bigger buildings. So yeah, to answer your question, the eastern part of the market started off as a big box market, and then over time it started becoming more infill, and developers were just building whatever they could get their hands on as far as, closing on 20-acre parcels and building a 400.
Yeah, because when vacancy rates were less than 1%, if there were no options in the West, you had to go East.
That's right.
If you had a 200 or 400,000 square foot requirement. And as those tenants are now kind of, as those tenants are now kind of leaving, it's leaving some inventory.
Yeah, so I think what's happening right now in the East with these high vacancy rates, it's just kind of the hangover effect from overbuilding and overdevelopment in the run-up of the cycle in 21 and 22.
Moving in the 500,000 square foot plus in the East, this segment is actually similar to the West. It's actually not doing that bad. There was actually a few deals that were done in this size range. The rents are holding to a degree. There were 4 deals done in this size range with credit companies and averaging out to about $1.05 a square foot gross. What would you say, it might be more of the same, but why is this segment held better than the others?
It just goes back to my earlier point. The bigger tracts of land for the bigger buildings are harder to find. And so lately there's just been anything above 500,000 square feet. They're sticky buildings. Once a tenant goes in there, they hardly ever come out, and it's just harder to find and it's harder to reproduce.
Well, good. I mean, is there anything else you guys would like to kind of touch on before we wrap this up for the viewers to know about what happened in the last quarter of 2025?
I'm curious to know where you guys specifically think land is going to go. Because the construction numbers, I mean, we got 4.5 million square feet under construction, which is,
Which is a little, because we typically deliver 20 million a year.
Yeah, that's what I was saying. Like earlier, year over year, we were 20 to 25 million square feet under construction. Just boom, boom, churning it out.
And right now, I think you said 4.5, and that's really, it's comprised of three big developments, one in Ontario, one in Fontana, and one in Menifee. That basically makes up that entire number.
Why do you think that even those 4.5 million square feet are still under construction?
Why? I mean, I think the motivations are probably different with every developer, but some of it might just be they have to get the projects out of the ground. I mean, they don't have the flexibility of sitting on the sites.
So I mean, there's entitlements that they have to build on that are going to expire, or maybe
capital might not to be returned. Things that are kind of outside of our purview. But I mean, those are the motivations pushing the projects.
I think with respect to the ones that are under construction right now, those are being built because they have bigger buildings. But I think your point is correct that we're in 2026. We're still going to see some development happen, but the ones that you are going to see happen in 26 are going to be groups like in the situation that you explained, that they have entitlements that are expiring, and in that situation, they'd rather take the risk on the market than take the risk of losing their entitlements.
Yeah, and I can't really predict when land is going to come back. I mean, the obvious thing, I'm going to say something that's going to sound very obvious, but once absorption picks up, right, there's going to be sentiment in the market, and that's also going to fuel for rent growth.
Yeah.
I think once you start to kind of see those two things happen, then people can sit there and say, well, at some point, we're going to be out of inventory, right? And they can start making bets on buying land. Now, where the values shake out to be, I think that's when things are going to start to reset.
Yeah.
And question is, are there going to be landowners that transact? And that's to be determined. I mean, we had a developer on a couple episodes ago, and he had a creative way of thinking about how to approach joint ventures with landowners, which I think is a good way to go about it, because it allows the landowner to participate in the market cycle upside, especially given how long the entitlement and development process is now looking to be. It might be a multi-year process, but we'll see. I think it's going to be quiet on the development side for some time.
Yeah.
And I think that's going to be the hard part for the landowners, that in their mind, they're, this is at least in the western part of the market, in their mind, they thought the land used to be $100 a square foot. And now they're going to have to come to terms with, maybe half, at best, it's worth half of that. And that's really all the and that's just really based on to what a developer can lease the building for. But these landowners don't really understand that.
Sure.
And they're going to have to come to terms with that.
Yeah, I mean, there have been some and you can speak to some of these land comps. There's been some land sale comps, but they were to users. They were not to developers who wanted to do spec development, because the valuations for a developer to do spec development feels like half of what those comps are.
And even in the larger buildings, it's very difficult for developers to get construction loans right now, and so it's almost impossible in the bigger buildings, and it's nearly impossible in the hundreds to 200. So you're not going to really see many of those come out of the ground.
Great, guys. Well, I appreciate you guys coming on. We look forward to doing this next quarter as well. Hopefully we have some good deals to talk about then. All right, boys. Thank you much. Thank you for listening to Adding Value with Shy Assar. We'll continue bringing on guests with stories and insights that matter in the world of industrial real estate. If you enjoyed today's episode, please share it with a friend or colleague. And if you're a landlord, tenant, or investor exploring opportunities in the Inland Empire, feel free to reach out to us. We'd be happy to help you navigate the market.